Hi everyone, quick update here. Last week I posted a video analyzing the gold market and it's getting tons of views and questions, especially about where gold prices are headed. So let's cut through the noise here. By the way, this isn't any financial advice or investment recommendations, but just my analysis based on observable trends. Let's get into it. About short to medium term outlook, I think it's still bullish. And will we see a gold crash? Not in the cards, not in the short term. Let's break down the fundamentals. Back in March this year, I outlined the two drivers of gold prices, among others, right? First one is central banks' gold accumulation remain very strong. Governments and institutional investors globally are still beefing up reserves in gold. This isn't changing. If we look at the fundamental data, US is still the countries with the largest gold reserve of exceeding 8,000 tons, which is followed by Germany, Italy, and France. If we look at China, so China is still lagging behind in terms of gold reserves with only slightly above, I think, 2,000 tons. China would definitely still be buying it. If we also look at the Q4 2024 top 5 countries buying most gold in the world, we have seen Poland, India, China, for sure, and also a few smaller economies. The number 2 is federal rate policy remain critical. While rate cuts might come in 2025, I'm kind of hearing maybe 2 to 3 times of rate cuts in 2025 and a few more maybe in 2026. Now let's also address the elephant in the room about the dollar collapse. The US dollar still dominates in many aspects. For example, more than 60% of MSCI global equities exposures are still in US dollar. More than 80% of international trades are still transacted in USD. And central banks around the world hold in total 12 trillion reserves in USD. These are the facts that are not disappearing overnight and even in the foreseeable future. Let's forget about the USD collapse theory. And let's also look at the historical context when we are thinking about whether gold will crash. In the history, we have seen 3 major gold corrections since 1980s. January 1980 to August 1982, we have seen 60% plunge in gold price. At that time, there was Fed rate shock. To combat deflation, Fed hiked rates to 20%, pushing real yields into positive territories and killing gold's appeal as a long-yielding asset. And there was also policy manipulation at the time. The US government and banks allegedly coordinate gold sales to suppress prices during the Bretton Woods collapse. The second time is the 2008 global financial crisis. We have seen 34% correction in gold price. So remember, at a time of extreme liquidity crunch, after Lehman Brothers collapse, investors dumped gold to cover margin calls. Also, deflation fears. Market at the time braced for a prolonged downturn in the economy, weakening gold's inflation hedge narrative. In 2008, we also seen dollar surge. Investors flocked to USD as the safe haven, with the dollar index rising 8% during the crisis. The third time is in March 2020. We have seen nearly 15% drop in gold price, which is COVID-driven. In a time of global deleveraging, global stock markets panic trigger mass liquidation of gold ETFs. Over 100 tons flowed out in March 2020. We're also seeing oil price shock at that time. WTI crude's negative pricing spiral amplified deflation worries. In margin calls, as we mentioned, hedge funds unwound leverage gold positions to meet collateral requirements. So, what are the key patterns that we have seen in gold's big drops? Real rate spikes. Federal Reserve tightening cycles will kill gold's opportunity cost advantage. Number 2, liquidity crunches. Extreme market crash forces fire sales of all assets, including gold. And third, policy intervention. And fourth, strong dollar cycles. Sustained USD rallies such as 1980s, 2008 will kept gold's upside. Finally, here is the important caveat. I'm not advocating purchases at this timing. At about 3,400, the risk-reward calculus just get dicey. This is strictly analytical. Do your own due diligence. And the final thought is, gold remains critical hedge, but don't confuse tactical moves with strategic shifts. The gold's dominance and central bank policies still underpin the system.